provides a different take again on the determination of asset prices and their link to the macroeconomy, based on his own research and practical investment experience over a long and distinguished career. There are a number of ways in which Smithers' model deviates from the mainstream. Let me highlight two. First, it puts center stage an aspect of finance often less focused on, namely the economics of the stock market. Second, it puts center stage the behavior of the managers of companies, as distinct from their household owners, linking this to the fortunes of the stock market. While these might sound like relatively modest modifications of the core model, Smithers draws out a set of implications that are often significantly at odds with conventional thinking, both when it comes to the determination of asset prices and the functioning of the economy. To give an example, in Smithers' framework, the level of bond yields and equity returns are not codetermined. That leaves the gap between them, the equity risk premium, able to deviate significantly from normal levels for protracted periods. Smithers brings empirical evidence to bear, largely drawn from the United States, to explain and justify these alternative hypotheses. Putting the behavior of managers of companies at the center of a joint explanation of asset market and the macroeconomy is, I think, a significant step forward in enhancing our understanding of both. The way the risk appetite of company managers is shaped by stock market performance in ways which affect investment and financing choices are issues not yet fully or adequately incorporated into mainstream macroeconomic models. Certainly that is true by comparison with the effort devoted to studying consumption choices by households. One of the signature macroeconomic challenges of our time, a challenge made more acute by the global financial crisis and by COVID, is the global productivity slowdown. This has many and various causes. In a growth accounting sense, a significant part of it reflects a slowing in the rate of capital accumulation of companies in a large number of advanced economies. Smithers' model provides a clear and compelling explanation for this behavior, rooted in the short-term behavior of managers of and investors in companies with the performance of the stock market at its center. Many in the economics profession, the investment management profession, and beyond will probably take issue with some or many aspects of the model, the evidence, and the hypothesis Smithers sets out here. In fact, it would be disappointing if they did not, because this book provides, for me, just the sort of revisionist thinking and intellectual challenge the economics, investment management, and indeed policy-making communities need if our models are to match the data, in particular over the longer run, and if they are to offer a more useful guidepost for decision-making in the future than has been the case in the recent past. 1. Introduction. Economic theory has changed little over the past 50 years. The consensus, termed the neoclassical synthesis, has been subject to refinements and tinkering, but left fundamentally unchanged. Despite attacks such as Nicholas Kaldor's comment on the intellectual sterility engendered by the methods of neoclassical economics, it was until recently believed to provide a solid basis for policy, a view which was, however, treated with scorn by Hyman Minsky, who wrote that modern orthodox economics is not and cannot be a basis for a serious approach to economic policy. It was previously assumed that by following the precepts of the neoclassical consensus, the economy could be kept in balance with mild fluctuations in unemployment and inflation occurring around a trend of steadily rising output. But following the financial crisis and the Great Recession of 2008, the questioning of this view has become increasingly vociferous. The major weaknesses of the previous consensus is seen by many to lie in the failure to incorporate finance into its economic models. Half the U.S. economy's output is produced by companies whose behavior is determined by the fact that their shares are quoted on the stock market. Once this is accepted, the economic model that follows is very different from the neoclassical consensus. Unlike the latter, its assumptions are testable and prove robust when tested, and it radically changes our understanding of how the economy operates.